Welcome to the Capital Allocation Station on this tech edition of Industry Focus. Greetings, fools. Sean O'Reilly here at Fool Headquarters in Alexandria, Virginia. It is Friday, April 15th, 2016. Happy Tax Day. And with me in studio is the incomparable, the snappy dresser, Dylan Lewis. What's up, man?
Doing all right. I will say I think Capital Allocation Station is probably like the worst sounding ride in an amusement park.
That's almost as bad as the band name for the fake band that you're going to have editorial head up, which was
the inefficient market hypothesis.
Oh my God. It actually, oh man, it's so good.
It's such a good finance nerd joke, but
Right.
It's one of those things that everyone else is like, oh, come on.
I don't know. I like it.
Yeah.
Anyway, just so everybody knows, we're going to be talking about just capital allocation in the tech sector, and it's, a little bit more boring than we usually talk about, but we're gonna make it snappy. We're gonna make it cool. And the other alternative that I was gonna mention was this is basically you and I telling companies how to run their businesses and their treasury departments.
Yeah. We'll do a little run through on capital allocation, some of the different forms it might take, how you might hear about it in the news. One company that did not do such a great job with their capital allocation.
It was yeah.
And another company that's done a very great job.
So Dylan, for those that may not know, what is capital allocation?
Yeah, capital allocation is basically how a company decides to divvy up their financial resources. And the goal, of course, being to maximize value for shareholders. So it might be unfamiliar as an umbrella term for some people. Investors will generally recognize the different actions business can take, though. So, like, you think about things like share repurchases, initiating a dividend or growing that dividend, plowing money into research and development, purchasing new property and equipment, making an acquisition, something like that. These are all types of things that play into the idea of how a company allocates its capital.
And obviously, it requires making a judgment as to future returns for any of those initiatives. And there needs to be a hurdle, and all that stuff needs to be done. How would you say, just for the layman, a business should make those decisions given where they are in their business cycle or anything like that?
Yeah, I think
where they are.
The things that are most predictable, and I think probably the things you hear about the most as an investor, are repurchase programs and dividend payments. It's really hard to anticipate something like an acquisition. Research and development is obviously kind of this ongoing thing behind the scenes, and you don't get a ton of insight into it. So those are the two that really stand out. And for those two, I think it really depends on the business profile. So you have, your high growth company. They're in a phase where they're plowing money into R&D. They're trying to build out maybe Salesforce to better sell their products, grow the top line. They're going to be looking to hold on to their capital, push it into different types of innovation.
Because theoretically, the money that could be made with their fast-growing operations and forming out a niche market is better than paying out a dividend to shareholders or something.
Exactly. Like if you're growing your top line at 30%, something like that, you shouldn't be passing along a 3% dividend yield to investors. The money is much better spent investing it internally and just growing that engine. And typically, these are going to be your mid, small cap companies. They also tend to have your less stable cash flows, right? I mean, you don't want to be committing to...
Or lack thereof.
Yes. You don't want to be committing to a dividend program in particular, because once you initiate something like that, game on. Like, people are expecting it all the time. Or even just announcing share repurchases, if you don't have the money set aside to continue to grow your business and also handle those other operations.
It's amazing to me, and it's, I think, been a real treat, particularly for the tech sector over the last 20 years, to see the high-flying tech bubble names like the Ciscos and the Microsofts and all those things. These things had like multiples of 300-400 times earnings. They had no cash. Like, it was just crazy. And now... Apple has more money than the federal government of the United States. Microsoft's a steady dividend payer since 2003. Cisco, which was, I remember their multiple write-ups in 1998, 1999, 2000 that we studied in my business school classes in 2000, 2004. That was just egregious value. Like, this company should not be valued this way. This is crazy. Like, they don't, and now they have a $50 billion bank account. They pay a dividend. It's a value stock by any metric, as I've highlighted in previous episodes. So the dichotomy there and just the change that's occurred is crazy to me.
And all those names you highlighted have made that transition, right? From being that high growth company to now kind of this second class of companies.
We've seen them grow from crazy wild teenagers to mature adults.
Right. So, they're in more of a steady growth phase, probably somewhere in the single digits in top line growth. I mean, generally that's where you tend to see these. Consistently profitable, nice, reliable cash flows. These are all companies that are going to be more likely to return capital to shareholders via repurchases or dividends.
Right. Do you have any companies that come to mind that you really like that have done this over the past?
Well, I think just a case in point in tech companies maturing is Google.
Yeah.
I mean, we talked about maybe, I don't know, 2 quarters ago, 2 earnings reports ago, they initiated or they authorized a share repurchase program to the tune of, I think, like $5 billion or something like that.
And that was the first one ever?
First one ever, yeah. And, and this is a company that's been notoriously growth,
Right.
kind of
throwing money at everything.
Sidestepping being friendly to Wall Street. Their new CFO is much more Wall Street friendly, Ruth Porat. But that's just an example of a company that invested in growth for such a long time and, was profitable for such a long time, but only recently decided, all right, we're going to, give a little handout to our shareholders via share repurchases and kind of rein in what's been going on in terms of shares outstanding.
Yeah, one of my favorite examples, and this is, going back a while, but we were coming up with the ideas for this show, and it sounds crazy that Buffett would do this, but Buffett actually bought a tech stock in the 1970s.
Did he?
Yeah, like it's you grow up and you're like, oh yeah, Buffett doesn't buy tech stocks, he buys Coca-Cola and just
he likes boring companies,
right? And it's because they're steady and predictable. Dylan, come on. But it was specifically for the reasons that we're talking about. They made this really great shift to being a responsible capital allocator in buying back shares and all that good stuff. Under the leadership of Henry Singleton in the 1970s, Teledyne Corp. I think it was actually Teledyne Technologies, and this was like a quasi defense contractor tech firm. And it was actually a remnant, and it was originally founded in 1960. It was part of the 1960s conglomerate boom. We're going back 40 years here, but finance doesn't change much. But then the 1970s bear market happened, and if you thought that 2008, 2009 was bad, 1973 and 4 were equally as bad. Like the average multiple on the S&P 500 was like 7. It was low. Like it was really, really bad. So
that sounds like you're leading to a buying opportunity.
Yeah, no. And so what Singer did was their stock dropped from like 40 to $8, and he had issued a ton of shares into the conglomerate boom. They had all this cash lying around. They had all these arguably stable, great defense contractor-y type stable businesses. Started buying back tons of stock over the ensuing 10 years. I had some data here. Hold on. In the ensuing 10 years, earnings went up 89%. Shares went up.
You mean individual share price?
Yeah. This is really, really good. Annual income increased by 89% and net income increased by 315%. The stock, on the other hand, went from $8. Now, remember the high previously was 40 to by the end of the decade. By 1976. End of the decade, $175.
Wow.
Because of all these share buybacks.
Yeah, and because that pie is
17 bagger, like this is better than a 17 bagger. And it was all just because this engineer CEO of a tech firm was smart enough to know, okay, yeah, we probably shouldn't buy other businesses. We probably shouldn't invest in R&D. We should probably just buy back our shares because we're trading at a ridiculously low valuation compared to where we should be.
And of course, part of that share price appreciation is the fact that the pie is being split in much fewer slices once business prospects turn around. Right.
Yeah, the share count goes down, and even if your net income stays the same, the piece of the pie is increasing, and your earnings per share go up, and the earnings that you own or have claim on are higher.
Yeah, and I think that perfectly highlights, one of the big advantages of repurchase plans and that style of capital allocation, where you have the opportunity to opportunistically buy when shares are low and take advantage of possibly the market undervaluing a company. I mean, obviously, who should know better about the prospects of a business over the next couple of years than the people managing it?
Than the CEO.
You would think, right?
One would think.
I do think one of the things that tends to get overlooked with capital allocation and the theory with dividends is that by issuing dividends, becoming a dividend payer, you are essentially saying, we're doing this every quarter, every year, whatever your term is, and you're kind of locked into that, and that attracts a certain type of investor.
Right.
When you commit to a dividend program, you're going to get people that are income-oriented, and you're signaling to people that in a lot of ways they can kind of set and forget their investments. They're going to collect that yield over time. And
not only that, but they're saying that we think our shareholders can do better with this money, even after paying taxes on those dividends, than we can, at least this chunk.
Mm-hmm. And it does offer the stock, I think, a lot of stability just because people are buy and hold.
Yeah. So, yeah. All right. Well, after the break, we're going to profile two different companies, one we think was smart with its capital allocation decisions and one that wasn't. Before that, I wanted to highlight to our listeners, as I have in the past, that for those of you looking for more great foolish content, a special offer for the Motley Fool Stock Advisor newsletter is available to all industry-focused listeners that works out to $129 for a full 2-year subscription. To take advantage of this offer, just head over to focus.fool.com. Once again, that is focus.fool.com. So, Dylan, who's going first?
Rock, paper, scissors, shoot.
Okay, ready?
Rock, paper, scissors, shoot. All right, I won. I'm going to go first.
Darn it.
So I'm taking the company.
You knew I was going to go scissors, didn't you?
Yeah, I had you read. I'm going to take a company that did not do such a great job, and I'm going to talk about GoPro. And so based on just profiling, like we talked about in the first half of the show.
Why are you hating on GoPro, Dylan?
Oh, I mean, I'm an Ambrella shareholder, so I want to see GoPro do well.
Yeah.
But based on what we talked about in the first half of the show, by all indications, GoPro is in that growth phase, right? And they should be fueling
They
R&D.
just went public.
Yeah, they went public within the last 2 years.
They do not have a dominant market position. They are not minting cash flow.
They're in nascent consumer tech market. But in the fiscal Q3 call last October, they announced our board of directors has recently approved a stock repurchase plan of up to $300 million. Our newly authorized Class A share repurchase program runs for 12 months, allowing us to remain opportunistic buyers and return cash to shareholders. So at the time that they announced this was late October, they had about $2.5 billion market cap, trailing PE in the mid-20s. So actually, given what their growth had been, not crazy. And I do understand I think they were at 16% year-over-year growth in 2015 overall. I do understand seeing that PE, seeing that valuation, and wanting to be a little bit opportunistic and having the flexibility to do that. But I do think there are some major red flags that should have been present at the time.
Especially to management.
Yeah, and so during that announcement, this was also the same quarter that they missed guidance for the first time as a publicly traded company. So they...
Dun, dun, dun. And very early in their history as a public company.
Yes.
So, yeah.
And Woodman, Nick Woodman, the CEO, said, in attributing that misguidance, had said, looking back, we now believe that we underfunded marketing in the second and third quarters of the year, which impacted demand. To address this, we're taking a more aggressive advertising approach in the fourth quarter, which includes a return to television following a 1-year hiatus. So...
Not good.
Yeah. You're talking about how you should have allocated internally to, selling and advertising. And then you're also announcing that you're going to be possibly buying back shares. It just seems like you're misprioritizing where money needs to be going. Of course, the following quarter, Q4 2015, they went on to misguidance again. And ultimately, in that call, they kind of provided an update on what the repurchase program was looking like, how much had been executed.
This is going to be bad.
So they said, we've repurchased 1.5 million shares at an average price of approximately $23 for a total of $35.6 million through December 31st. We have a remaining share repurchase authorization of $264.4 million. And if you remember correctly, they IPO'd for right around $24.
And I also know that they're about 13 or 14 right now.
Yeah. So they didn't get a huge discount on what they had originally sold those shares for.
Right.
And in the, so they also, based on that cost basis, clearly executed that first 10% of the share repurchase authorization immediately after they announced it.
Right.
And the shares are down, the ones that they bought, 40% since they executed it.
The dichotomy here between this and, by saying this, I'm not advocating that GoPro start an online bookstore, but the dichotomy there between them and Amazon that literally says, we ain't buying back any shares, we're not going to pay out dividends, we're just going to keep investing in our operations until we win.
Yeah.
Big black and white difference there.
And I think I do understand, a lot of tech companies issue equity as... they do share grants as part of their compensation. And I do understand wanting to have this as a way to mitigate against shares outstanding getting crazy out of hand and diluting existing shareholders. But this is not a company that is entrenched in this very stable space. Like I said, they're in consumer tech. They're making pushes into virtual reality capture and drone capturing. Both of these markets barely scratch the surface. It just seems odd to me that they're prioritizing something like this. And, I mean, the fact that they timed it so poorly shows that management doesn't have a very good finger on the pulse of what's going on with the business.
Yeah, and actually that's a great segue to the company that I wanted to highlight, which is Microsoft. Mm-hmm. They have arguably had a monopoly since the late 80s. I mean, who are like 90% market share the entire time of the PC market, probably higher. They didn't start paying out a dividend until 2003. As I'm going to point out in a second here more in depth, they didn't really start buying back shares in earnest until the mid-2000s. They bought back a few, like I think we looked earlier, it was like a couple $100 million, and that was clearly in the 90s. And that was clearly just to kind of take care of the dilution from all the options they were giving employees. They have a monopoly. They're generating billions of dollars in free cash flow, and they didn't even do what GoPro did until way later.
Yeah.
I mean, that's just like...
That's baffling.
Guys, like, what are you doing?
So what else do you have in terms of Microsoft strengths on the capital allocation side?
What I wanted our listeners just kind of bring it around to know was... most of us probably know Microsoft shares have kind of languished a little bit since the bubble popped in 2000. Like, the stock was at huge multiples and everything, and they didn't really go anywhere until very recently, actually, until Ballmer stepped down and they got the new CEO, Nadella. They bought back anywhere from, after the bubble popped, $3 to $6.5 billion worth of shares in 2001 2005. The stock kept languishing, so they're like, we're making more and more money every year. Profits went from 2001, profits were $7 billion. They were $12 billion in 2005. They kept growing to over $20 billion by the early 2010s. So the business is doing fine this whole time, but the shares just aren't going anywhere. So clearly, as responsible capital allocators, they're going to be like, maybe we buy back some shares.
Yeah, let's slice this pie a few less times.
Exactly.
Right.
That is what they started doing in 2005 in a big way. 2005, they bought back 8 billion shares. 2006, 19 billion. 2007, $27 billion. And all of this is after paying that $32 billion special dividend in 2003. It was really funny to see this like huge $2, $3, $4. Yeah, just like boom. 12 billion in 2008, 9 in 2009, $11 billion worth of shares in 2010. And this whole time, at the depths of the Great Recession, the year when Microsoft bought back, $9 billion worth of shares, and the previous year they had bought back $17 billion, the PE on Microsoft got as low as 9. Mm-hmm. This is crazy awesome purchases that they're making.
Yeah.
The stock went from the mid-teens, like it touched bottom in 2009 at $15 a share. All those repurchases were made over the last 10 years, and now Microsoft is at 55.
Yeah.
That is awesome.
And looking at just their history as a company, they didn't start buying back shares. I mean, it probably goes back to somewhere in the early 90s, I think, their share buybacks.
But even then, it was just like $200 million a year.
Yeah, and it was to offset a lot of equity grants. But I think that they were in a much better position when they did that to continue to fuel the growth that they were needing to push.
Right.
And also take care of shareholders.
Right.
It wasn't all or one. And not to say that it was with GoPro, but they seem much more in the we need to grow, we need to innovate, we need to invest in that R&D to eventually get to this point.
Right.
It just seemed kind of premature on their
When GoPro is generating billions upon billions of dollars in free cash flow every year that you don't know what to do with to expand your market position, then do what you did.
Yeah.
But anyway, cool. All right. Well, thanks for your thoughts, Dylan.
Always a pleasure. I will say, Sean, if listeners are interested in hearing a little bit more on this, one of our Fool.com writers, Evan New, has put together an excellent article looking at GoPro's share repurchase program and some of the dynamics at play since their IPO. The headline is "Why I Hate GoPro Inc. Share Repurchase Program, and You Should Too."
He is not beating around the bush with
No,
that.
he's making it very clear how he feels about it. So if you go to Fool.com, you can find it there. A little bit more insight than we scratched on the show.
Cool. All right. And if you're a loyal listener and have questions or comments, we would love to hear from you. Just email us at industryfocus@fool.com. Once again, that is industryfocus@fool.com. And as always, people in this program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against those stocks, so don't buy or sell anything based solely on what you hear on this program. For Dylan Lewis, I am Sean O'Reilly. Thanks for listening, and Fool on.